Good evening, everybody, and welcome back to another episode of One Big Stock Market Sundays with me, Will, John, and Jordan. How are we, lads?
Very good.
Yeah, all good. How are you?
Yeah, I'm good, man. I'm good. It's been a busy day. Will, before we get into something, I'm going to pop your screen straight up because I know you wanted to share something with us. So I'm going to pop it up right now.
Yeah. So I just had a really funny blooper from doing the thumbnail for this week. So this is the first thumbnail. I accidentally typed in sniffing and not sitting. so me and John are sniffing the chairs. That's absolutely ridiculous.
You weren't meant to share a secret habit.
Yeah. And I thought it looks a bit bright for quite a heavy topic later, so I toned down the map as well. But yeah, I was just sat there for 10 seconds, what? I was so puzzled, and then I went back and looked what I typed. I was like, okay, but it's there we go.
No, that's funny, man. That's anyway. a nice way to start the stream off. Well, George, like normal, if you want to swing straight back in and talk about the predictions from last week.
We've had a momentous week. Stream have doubled their points, have gone from 1 to 2. I don't know what the week drought was, but it was quite a long one. So nice to see them get a point, and a point for everyone else, just except you, Jay, unfortunately, with the one sort of differential pick going green. The week was red. I think it was the most red week we've had so far, the sort of the current streak that we're on. So yeah, things are definitely spreading out more and more as the weeks go on. Same for our total predictions, same for our scores, and we'll see how that continues to go.
It's also now 5 red weeks in a row, in terms of the actual market. So it just shows kind of what kind of situation we are in the wider market as well.
Yeah, and I think, like I said, this week's been a little bit of an interesting one. Obviously, we're going to see how the next couple of weeks, but we'll come back to that. I'm just about to start setting the poll up, but I'll sort that in a sec. So first things first, me and Jordan are going to touch on Ondas. So their fourth quarter this week, they released their earnings. It was a very good earnings call and earnings presentation in my own opinion. So some of the leadership team, I think. Why it's worth mentioning this slide straight away, because I think Eric gets a lot of the love for a lot of the stuff that he does in this stock, which is great. But Oshra Lugazi, he absolutely kills it on the side of things. He runs most of the OAS, if I'm honest, from talking to Eric and stuff. That's mainly what he does. So all of the great stuff that you see, yeah, it's obviously Eric that does it, but Oshri does a lot of the work in the background. So the sustained momentum. So George, do you want to jump in on this one?
Yeah, so I mean, it's been a pretty staggering quarter, and also it's Q4, so just reflecting on the year as a whole, it's been quite a big year for Ondas, and some of the numbers won't necessarily be a surprise. Between Brad, yourself, Jay, Tucker, and Chow on the server, a lot of these numbers we get shared as soon as they become available. That people the lads are really on it in the Discord server and in the Ondas channel specifically. The revenues have been crazy. You can see there on the slide, just over 50 million reported for the whole of 2025, and the quarters going exponentially. We talk about growth stocks quite a lot of time, and Ondas is definitely the definition of that. I think the revenue beat was around about 7% in the end, sort of in that region. I know the EPS was a big miss, and if you're in the server, you would have already sort of gone through and seen some of the explanation about that, but just wanted to touch on it here. So the EPS miss was largely due to sort of a one-off accounting change of 82 million, and that's to do with warrants, which is basically just a reality of accounting and how accounting works, and the way that goes through it makes the EPS numbers look a bit scary in terms of how negative they shift and how it dropped below expectations by so much, of 5 times more negative than it was expected to be. But then if you look at the underlying numbers, and there'll be a slide later on about where we can see sort of some examples of the operating margins, etc. I think the margins as an overall have gone from 21% to 42%. So the underlying business is really healthy. It's growing and it's improving its efficiency even more. But just to touch on the EPS side, so just to explain it for those who don't really understand it, why it's the case, why the kind of accounting comes through like that, and why for the most part I think it's something to not really take too much notice of. It doesn't really change, I think, for me, the fundamentals of the stock. So it's to do with their warrants that they had issued. And if you think of warrants like coupons, if you like, investors that are buying the warrants, then it kind of helps you to understand that a little bit more. And as I say, it's more to do with the accounting, which is why it affected the numbers so much. So the warrants are treated like a liability. So when they go through the accounting and they run numbers, that liability is written down as a debt that the company owes. And when you have the positive situation that we've had, where Ondas's stock price has raised a lot, the value of those coupons, the value of the warrants, has increased, and therefore the debt or the liability that they owe against those warrants increases as well. And they've obviously got to note that down. So although the stock price is going up, the value that they are liable to give to those investors through those warrants increases, and they've got to note that down, and that gets noted down as a debt, and therefore comes off of those numbers and brings them down. So it's just, as I say, like a formality of accounting, and it doesn't really change much about the company. As I say, it only comes about because the share price has gone up so much and those warrants have become so worth it. So as I say, I don't think it's too much to take notice of. But yeah, the revenues are up massively. As I say, the margins are up massively, and again, it's like a definition of a growth stock, and it's exciting to be this early on something that's growing this quickly.
And then another interesting thing that was obviously came out in some of the Q4, they tried to make sure on the presentation that they spoke about everything ahead, because obviously they had the investor day in January, and obviously they touched on pretty much everything that happened last year. So they tried to make this investor call about what was going forward. And we'll obviously quickly go through them. And Onberg was a great thing that we've seen come from Ondas the last quarter, seeing that further mixing into the German side of things in Europe, which is obviously touching over on the opposite side of the pond, which is great. One of the big ones that we've seen, obviously, was an announcement, obviously, with Ondas, Palantir, and Worldview. I'll obviously do a video soon breaking it down further, but this was a massive collaboration that obviously Palantir approached Ondas with, and they ended up doing something. This is something that will end up being an absolutely incredible one for them, from the stratosphere all the way down to the ground. This is going to be something that is massive for them going forward. A deal with Ondas, Worldview, and Palantir. So it's where Ondas is obviously, and Worldview will put the structure in, and Palantir will help on the trying to think of the word, technology side of thing. Anyway, so what they do, Worldview, obviously they've got all the Stratolite fleet. George, did you have any thoughts on this when you've seen this? What you think about stuff like this?
It's cool to see the ambition. I think early days it could have been easy for Ondas to almost stay within their own lane with their Iron Drone, or with the rail side, and just like sort of max focus on that, reinvest everything to just that, like be as efficient as possible and competitive as possible in just sort of those small sections. But they're not doing that. And you can see that through their mergers and acquisitions, like how many different sort of subsectors of defense and counter drone technologies they're getting into, and how much they're expanding effectively what would be their full stack package or other ecosystem, if you like. And it's nice to see that ambition and that growth into so many different spaces. Like two years ago, or even a year ago, none of that even seemed like it was a possibility or suggestion that you might guess they'd move into. So it's nice to see that ambition and that intent to create such a wide sort of umbrella under the Ondas networks. Yeah,
totally agree. And you pretty much just touched on that there. But the fact that they're touching so many different domains, and literally, as it is on a systems of systems, so we're literally touching out into the stratosphere. We've got the air, we've got the surface and land. I did ask Eric earlier about obviously water-based drones and stuff like that, so people will have to tune in tomorrow for the interview to see how we touched on that for sure. But it is something that I think will be something that they touch on very soon. George, before we just jump into the next bit, a question that's here: could Ondas not buy out these warrants?
So they could, but I just don't think it makes sense for them to do it. So they're in a place where they definitely could. I don't think many companies in their position can, and that's because obviously their stockpile of cash that they have, the position that they're in. But they're in a very aggressive phase of expansion and mergers and acquisitions, and that would mean reducing those or sacrificing those for the sake of buying back those warrants. And ultimately, they issue those warrants for a reason. They got some upfront capital, but also if those warrants get exercised, and they get even more capital again. And as much as it may dilute them slightly, I don't think it's worth them using their cash that they're obviously looking for expansion and for scaling up and for mergers and acquisitions, using that to get rid of the sort of paper losses that don't really count as losses, or to get the warrants away, because they, by nature of issuing them, they want those warrants to exist, and they want that sort of pipeline of capital to come in. But they can. I just don't think they will.
makes sense from, like you say, not to really. They're there for a reason. Income statement. What's your thoughts on this, mate?
Yeah, so this slide sort of just to, as I mentioned a few minutes ago, just to look a little bit more at the sort of underlying business and looking at the margins. So if you sort of cross your eyes across the revenues, the top line there for each year, and then just a couple of lines below the gross profit, and you can sort of see the ratio. So from 4 to 30 is what, like a 7 point something multiplier. From 800 to 12,000, or in this case 800,000 to 12 million, is a much bigger multiplier. So their actual margins and the underlying business is increasing, and you can see that on the right box there. The third bullet point, gross margin increased to 42% in Q4 versus 21% in the prior year, driven by higher sales and a favorable mix. So that's going to be natural as a part of getting winning bigger contracts. And I think we've seen that where they've announced so and so a major international airport in Europe has sort of deployed it, and then that repeat customers coming back, and then they'll get expansive, they'll get bigger contracts and bigger deals, and then by nature those can be more favorable. And when they're pushing more into a more competitive market, and they themselves are offering a more competitive package, then they can also price themselves higher. And it's also the other thing of the more you scale up, the easier it is to drive up your profits, because you're working at a bigger capacity and a bigger scale, and sort of like the smaller numbers don't sway your overall numbers as much. So it's nice to see the underlying side improving as well. They're not just expanding and everything sort of staying flatline within that. They're expanding, and the sort of like the sub numbers that really matter are also expanding too.
No, that's a great take on that. So you're always better with the numbers than me, George. You explain it better. So this one was an interesting one. So I'll let you touch on this one first, and then we can baton back and forth if there's something you want to. So what's your thoughts on this one, mate? The institutional support growth.
Yeah, so I thought it was just like a really nice bit to focus on. Sort of like, I think we talk about the guidance and rhetorics of earnings a lot, sometimes being more important, or often are more important than the numbers themselves. It's what they're actually guiding, what they're forecasting. And this is a nice slide to see some of that. Even the bits at the bottom where they're sort of anticipating to be in those indexes and sort of push forward for that, how they see the rest of the year going. I think the Ondas for me it strikes a nice balance all the time of being optimistic and being promising, but also not over promising to the point where they put themselves at a sort of touch and go situation where if they don't achieve what they've sort of over promised and been really, really optimistic about, then it looks bad on them. I think they strike a nice bit in the middle where they're not constantly massively underselling themselves, although I think maybe to a small degree they do, and they're not massively overselling themselves as well. They have a nice bit in the middle there. But yeah, just like the guidance that we've seen raised, I think from up to 375 million, which was like a double off of what it previously was. I know there's some discussion in the server that it could be even higher than that, and that's still quite a sort of a conservative number. Then also just to see who owns it, and that kind of feeds into how you'd expect the stock to be treated, if you like, or how fair it feels to own some of Ondas. And you can see there they made a point to highlight how much institutional investors own of Ondas, how much of the big money is in Ondas, and how much of retail investors and private owners there are, and also how heavily weighted it is. And to have the top 10 investors own about 15%, I think is really healthy. If you had one investor owning 15%, then similarly to we spoke a few weeks ago about Microsoft or Amazon, how much of their revenue might come from one partner. As much as those revenues and numbers are still there, and that investor in this case would be still there, it still feels less safe and less secure to have it not as spread out. So it's nice to see that, and they obviously, I think Ondas's investor relations have for a while now been really positive and really strong, and they're clearly, as a part of that, they wanted to highlight where that sort of financial strength is and give a bit of context to the numbers that is hard for us to look in and see ourselves, but they can obviously give much more clarity on. So as an overall, they as I say, they provided nice clarity on and a good forecast and a healthy level of forecast.
And I think something that was interesting for me, with obviously being an investor in Ondas, we know that is normally they don't sandbag, but they'll undershoot and then really overperform all the time. So the fact if they're anticipating additions to the Russell 2K and other indices sort of says to me there's already chatter there happening, because you sort of don't say that unless there's something already happening. And something that was another big take away as well was obviously the pre-funded warrants was $1 billion equity raise. That means that there was a $1 billion investor into Ondas, obviously, when they did that raise. But the fact that there's nobody that owns more than 5% either says that they diversified it over a few buy and shell companies, and that they did. or I don't know how they managed to do that. But the fact that there's no more than any 5% owners, that's always a massive thing to take away from that as well. But all in all, really, like it says here, they've got a really strong balance sheet. They've got massive access to capital that they're earning insane amount of interests on every day or whatever. And the fact that they're anticipating more exposure into these funds means that anybody that is invested now, once this exposure starts coming, it's only going to do the share price justice in the long run. Obviously, the shares outstanding is up. It's obviously 467 million. We obviously conversated about this the other day on the server. We do expect that to go higher, to around 500 million. A few of us had that same opinion. But ultimately, if you're in it for the long haul and you know what you're in and how they strategize acquiring companies, because I think, obviously, I'll come back to this at the end, Jordan, talk about it. When they're acquiring new companies, they use shares and some cash, which we'll offer both our opinions on towards the end of this presentation. But it's not always bad, but because people don't see that massive spike, it can sometimes be taken as a bad thing. So when they're building out their systems portfolio, because I just seen someone comment in the chat and they said they are diversified, and that does worry me a little, which is understandable, but people seem to think that this is solely a defense-based stock in regards to, because the stuff that's going on in the Middle East, this should be soaring, which isn't necessarily true. But they have got their fingers in so many different pies, you know what I mean? And that does make them obviously diversified. So we don't need conflict for it to be a great performing stock. I think the US, I should have had the picture ready, have got the most data centers more than anybody in the world, and it's by stupid numbers as well. And what we've seen in the Middle East is obviously Amazon centers being hit by drones. So had they had counter UAS or something in place, would that have happened? We don't know, because obviously it wasn't there. But obviously I think counter UAS is going to be something that's taken very serious going forward, which already has started happening in Europe. I don't know if what did you think about this, George? Because I thought about this and I looked at it. So the aggregated transaction value for these acquisitions, these five, is 557 million, but they're expecting 230 million worth of revenue from these companies in the first year of obtaining them. So, quote unquote, if there was no growth and they strategically hit those numbers twice in 2 years, they've nearly in revenue obviously hit the same amount as what they paid for this. What's your thoughts on that?
Yeah, we can, when we do the bit at the end about how they sort of acquire some of these companies, we can come back to it a little bit. But I think it's evidence of how well they've targeted their acquisitions. And yeah, you're right, as you say, that's their revenue coming back from what they paid, and obviously the real numbers to get their money back would be the profit. But it's just kind of show like the scale of what they paid, what they're getting back. You know, usually I think acquisitions average around 3.5 times roughly the revenue or sort of raw value to then what they are acquired for. And I think they've been, for the most part, either on that or just below. And obviously in the long run that will pay dividends. But it's really nice to see those acquisitions that have been, you know, they've been really large acquisitions, especially for the size, in early days, for the size that Ondas was. It's been quite ambitious to the size of these acquisitions, to the size of Ondas's networks as its own market cap. And it's nice to see them instantly, you know, coming back and already paying dividends, if you like, on those. And as investors, it's nice to sort of get that early affirmation of why they wanted to go for it and why it'll pay off for the investors as well long term.
Yeah, and like I said, they've aggressively been acquiring stuff, but it's already, like I say, I'm not sure how many times they've upped the revenue growth in the last couple of years, but every time that they seem to up it, they always smash it out of the park. And that what brings me on to the strategic growth program. So you wanted to touch on this one, didn't you, George? So
yes, it was kind of to say a bit of what I said in the Ondas channel on the server this week about, you know, how much they've been focusing on that aggressive expansion, on these mergers and acquisitions. And I know some people will feel a little bit hard done by, a little bit frustrated to see more offerings or more dilutions, and people sort of thinking, well, they've got this big cash pile, but they're not using that because they're using shares instead. And we can, as I say, we can round that off in our quick discussion at the end about how they're acquiring them. But I think I think for me, it's really important in this early stage of the sort of drone sector and the counter drone sector to be as aggressive as possible to grab market share. You know, it's a rapidly expanding sector and market that in the next few years will have a really big TAM, so a total addressable market, And I think that will continue to grow, because it definitely feels like it's going to be a big focus for countries, and as you said yourself, not just militarily, but also just infrastructure wise. We're talking about counter drones and detection and prevention, that sort of thing, and that's all about protecting assets. And assets aren't just what you use in a wartime. Assets you have every day. You have infrastructure assets, you have energy assets, you have transport, all sorts of different things that will still need some sort of prevention and protection outside of wartime. Of course they do, because if there's value there, then there's a need to protect that value. So yeah, just going back to the original thing, like for me, I became more bullish over the course of past sort of 2-3 months, where we've seen some of these big acquisitions come through, than it was beforehand, because it's that confirmation for me of the focus on just expanding as much as possible, grabbing as much market share as possible, so that when this sector is growing as it has. And I'm trying to remember, there was an image that was shared in the server quite a while ago, which I'll try and find and dig up, basically forecasting the total value of the sort of counter drone sector or market in the years to come, and how much it's going to exponentially rise and is expected to rise. And as I say, if you grab quite a big market share early on and you grow with that market, then you're going to end up with a massive market share later on. And I think for where Ondas is now and where the sector is now, that's the most important thing. And their merger and acquisitions have been complete proof in the pudding of them focusing on that.
Yeah, and I think adding on to the back end of that, like it even says here, the potential revenue from M&A in pipeline 26 is 500 million, but they're only forecasting for 375. So they're already saying that there's a potential there to do that. We're not even talking about, and people need to notice the small details, potential revenue from M&A in pipeline. That's not even talking about what's in play now. That's not talking about the backlog, which the backlog went from 24 million, I think it was, to 68 in Q4. And I asked about that today, and that was something that was a big topic we spoke about today. But I think they executed massively on the M&A on a pipeline, and that touches us back into this last bit here, where obviously the revenue target is at least 375 million. So they're not even guiding for 375 million. They're guiding for it at least is a minimum that they want to hit. They're expected 1Q 26 revenue of 38 to 40 million, which is a 600% year-on-year increase. I mean, for a growth company and stuff like, yes, it's expected to grow, but those are exceptional percentages in my opinion. And even the EBITDA and for the timeline, Q3 26 for their product companies, obviously Q3 27 for OAS, and then Q1 28 for Ondas Inc. as a whole. So yes, we've got 2 years-ish from now till they plan to be full profitable, which is understandable, but I'm okay with that. When you're buying these companies, you should be, whether you're new and growth companies, you should be having the mindset like we spoke about here a few weeks ago on the question of the weeks and stuff, where you will hold that stock 4, 5 to 10 years, which doesn't mean you will, but you should have that mindset. So if someone's telling you there's a company you're holding today at $10 is going to be profitable in 2 years, you know what I mean? I'm not losing that much sleep over it overnight. But what's your thoughts on that?
Yeah, I think a lot of people like to obviously monitor when stocks are like, and for SoFi it's especially relevant, like when's it going to get in the S&P 500, for example. And I think the switch going over the line from being non-profitable to profitable is a even bigger boost than that. And for those in SoFi, they would have seen that in recent times where SoFi became profitable, and the boost it kind of got. And it always feels like a real turning point when they make that switch. And as I say, when they cross over that sort of fine line. But in the meantime, you know, as you say, it's a few years away yet until sort of they feel fully profitable. But what they're doing in the meantime definitely doesn't feel like any complacency or any slowdown to getting there. And you can, for sure, a stock can grow in value and can grow with investor sentiment, all without being profitable yet. There's so much more to it than just how much money they make at the end of the day after taking off all the numbers.
Yeah, and I will ask you the question I wanted to ask you in a minute, George, that we can do it. But here's another one. What's your thoughts on Ondas? Just hit 30 million 2 to 3 quarters, but they'll be looking at 100 million plus by their projections. So I guess what that's trying to say is obviously we're going for 30, 40 million in Q1. But obviously if they're trying to hit 375 million by a year end, that means they're expecting like really big numbers for Q2, Q3, and Q4. And then my reason for that obviously is the fact that most of the acquisitions that they've done don't close till Q2. So the revenue that they're receiving from these companies, Mistral, etc., they're not going to start being effective till Q2, Q3, Q4. So my question that I had for you, George, is with the acquisitions that they're having at the moment, and they're doing it with shares and cash, instead of just doing it all cash. What's your perspective on that, and do you think that's good or bad?
Yeah, so I completely understand the people who, looking at that cash pile of 1.5 billion or whatever it might be, just below that now, expecting that they're going to use this for something really soon. That's why they've grown it, and then sort of a merger acquisition comes through, and then they see shares offering rather than just all buying cash, or they use a tiny bit of cash and they're mostly buying shares or 100% shares. And people thinking, well, hang on, what's happening? What's this $1 billion+ sat on the side for if they're not going to use it for these mergers and acquisitions to fund them? And I think on one point, I think that the cash for them is more focused and set aside as it's both something to give added flexibility, and it's also like a safety net. It props them up, and it's it's attractive to invest into a company that has a big cash pile like that. And I think it's more for sort of like their real scale up and manufacturing side and that sort of expansion. But actually, when you kind of run some numbers and think about the two side by side, often the making acquisitions with the shares makes a lot more sense. And especially a company like Ondas, which has run up 1,000% plus or around that number in the past 12 months, their shares, if you think of their shares like a currency, they're worth so much more than they were 12 months ago, and they're also quite expensive. I think if you compare something like, well, if something's like a low premium, lower value, then it hasn't got the same value behind it as something that's at a higher one. So if you like, their cash is a fixed rate, their $1 billion is worth $1 billion, and if their shares go up, their shares become a stronger currency, and they effectively end up being worth more than their cash, and they can buy more with their shares than they can with their cash. And then you can also create value for your existing investors. In that previous slide where we saw some of the revenues coming through from the mergers and acquisitions, and when you sort of mark them against what they paid for them, they seem to look like really good value. And if you're buying those cheaper companies with your shares, which are more expensive than theirs, then you're instantly creating a value gap, and you're instantly creating value for your existing investors. So it's a positive thing for those who are already invested. And the other thing is, if you're acquiring these companies with your shares, these companies become owners of your stocks and of your share of their now parent company, and your success is directly beneficial then to their financial benefit. They're not just being handed a lump of money or being handed a check. They're getting this effective deal where the more we grow, the better we do, the more money you're getting out of this mergers and acquisitions. From us acquiring you, you're going to do better if we do better. So you have your whole umbrella network more bought into the success of the parent company than otherwise if they just got given a cash settlement and then sent on their way. They've made their money. Whatever happens beyond that doesn't really change how much money they received, but when they've received shares, they can gain more and more as success goes up. So I think when you combine all those things, it does make sense to be buying with shares, and as they've mostly funded them with shares or funded them outright with shares, I completely get why sometimes it feels a bit counterintuitive to have loads of cash sat on the side and not use it. But I do think it makes sense. And as I say, I think that the big benefit there is the value they're creating. They're using expensive shares to buy good value companies with revenue already coming back and creating more value for the investor, which is the most important thing. You're on mute, Jay.
It's because, my bad, it's come up on my screen. And you just hit the nail on the head, and you've pretty much just covered exactly what I was going to say, because I asked that exact question to Eric earlier. And basically what I've got to say on that is, as well, just to touch on the back end of that, is if a company didn't see a future in Ondas being a good company, they wouldn't be accepting shares for their company. If they thought it was, and if every company was just being bought with cash, no one wanted shares, then they'd have no faith. So the fact that all these companies that they're acquiring are accepting shares in their purchases, it's in their best interest that the company does well too. So obviously, if they're being paid in shares, yes, short-term dilution, it seems crap and nobody wants it. But if you've got that long-term vision, and the fact that I think sometimes people need to zoom out, because I know it's up and down, so it's a little bit different, but this stock at some point is bouncing between being 1,000% up and 1,500% up for the year, which is nuts growth when if you were buying it a year ago. So yeah, that's definitely where I'm at with that. But I think it's a fantastic company. I'm looking forward to seeing what happens. And if you are investing in Ondas and you do like the company, there'll be an interview out tomorrow night with me and Eric, which I did today. So on the back of that, I think Will, you're going to jump in next, aren't you, mate? And we're going to get you on. You there, Will? Yeah, you're there.
Yeah. Yeah, so this week we thought we'd just mix up a little bit rather than jumping straight into this conflict, just go through obviously a major stock. But now I will be going through the conflict. I know it does look like a lot of tabs, but I'm going to go through fairly quickly, hopefully, this week and just give an overview of sort of what's going on in the last week and sort of where I think things are going towards. And again, like a little highlight of the macro impact as well. But I thought I'd just start off this week just playing this 30-second video. It just shows just all the targets which have been hit in Iran and over the course of the last month now. So we are now into day 29. Tomorrow will be day 30. Obviously, Trump did say very early on that he expects around a 28-day conflict. So we are now over that. And in my opinion, anyway, I don't feel like we're anywhere closer to ending it. But to go, yes, well, so to carry on. So they are striking civilian ships. So the Iranians are now hitting ships, which obviously isn't great. So those are in red, and then in green, we can see where Israel and the US have hit the Iranians, just to give like a different perspective on of what's going on. So obviously, of course, when vessels are being hit, we know already that that has a massive effect on the price of oil, on the price of gas, because ships just aren't going through. This is the current live Strait of Hormuz. I think the cargo vessels are in green, tankers are in red. So we know that I've showed this before. So 24 miles is the gap of the Strait of Hormuz. There's 2 miles of shipping lane going one way, 2-mile gap, and then 2 miles of shipping lane going the other way. So it is that real choke point. So as you can expect, in normal times, this key area here would be chocker with red, with green, and with various other vessels as well. Whereas right now, you can see there's not a single ship in the Strait of Hormuz at all. So yeah, as we expect, I mean, like this is the Iranians' major play. As I mentioned, every week now, they are using the Strait of Hormuz as a chokehold on the US and on the world, effectively say, you know, if you mess with us, we will mess with the Strait of Hormuz. And they're using it as like a leverage, but it's like it is quite clever, really, because normally their amount of barrels of oil per day is around 3 to 4 million barrels per day, whereas they're effectively leveraging up the amount of energy they control. So they're now controlling what effectively 20, 21, 22 millions of millions of barrels a day per day by controlling the strait, by threatening it, by saying that they will hit ships, being aggressive towards tankers. They are leveraging up the amount of energy they control and putting pressure on the neck of the US, but also the world, because as we know, as I've highlighted before, the US has a lot of homegrown energy, a lot of gas, a lot of oil, whereas actually mostly the rest of the world, countries in Asia, the UK, EU, Australia, which have a lot more difficult time to get their own energy supplies. Brent year to date up 90%. That's the key one for like the UK and like the main international market. Brent for the last year plus 40%, but like just look like it really has effectively doubled almost. Crude, again, you can see from the graph, it's gone from $55 to around $9,500 now, but I mean, who knows, it could be back to 100 tomorrow. The Dixie, the dollar index, which is against a basket of other currencies, the euro, the pound, the yen, that has continued to strengthen as it's supposed to over the last month, 2.7% effectively since this war started. I say, as it's supposed to, remember, the dollar is the ultimate safe haven. So in times of crisis, people buy the dollar, or they're forced to buy the dollar as they sell maybe gold, which then gets put into dollars, for example. But just to try and keep it super relevant as to why we should care, this is VUSA, the Vanguard Distribution UK S&P 500 fund, versus the S&P 500. So over the last 6 months, VUSA down 2.66%, S&P 500 down 4.39%. So that is solely down to the dollar strengthening. I know theme of 2025 was the dollar weakening, and our returns on ETFs and even individual stocks, to be fair, were a lot less in some cases than the actual index or the actual stock. But I just wanted to highlight that it does work in both ways, and in downturns, the dollar does strengthen, which means that we are cushioned for like the maximum drawdown in our ETFs and like in our stocks as well. If you go back to look at this in 2022, exactly the same happened. The S&P 500 was down around 22% at its peak, I think, whereas VUSA or a similar index was down about half of that. So it does just show you how currency is so important, but also it can work both ways. So I know a lot of people in the Discord were sort of half complaining last year, the dollar strengthening, the FX impact on Train 2 and 2 looked really bad. Well, now it's flipped, and it's 2-3% difference. I saw some people asking questions about gold this week in the One Big Join Discord as well, so I just thought I'd cover off that. So gold is seen as a safe haven in general, but ultimately the dollar is the ultimate safe haven. So in like a real crisis, people have flocked to the dollar and not gold. I think the particular bull case for gold was overprinting and general inflation, money becoming worthless, like the de-dollarization, which I still think is in play. I just think right now gold is being affected by one of its classic, its kind of classic cons. It doesn't have a yield. Like the only way to make money off gold is you buy it and it goes up and then you sell it. Like there's no dividend, if you like, right? So whereas if you buy dollars, if you buy treasury bills, if you buy the 10-year yield, 30-year yield, you're getting paid 4.5, almost 5% just to hold dollars right now. And obviously, still over the last year, gold is up 50%. So I think it's a combination of people taking profits, people preferring their ultimate safe haven, people preferring that yield. And also remember, there's an inverse relationship with precious metals and with the dollar, because precious metals are listed. Is that the right word, Jordan? Listed or
just priced in the dollar,
yeah, price, that's it. Yeah, so because precious metals are priced in dollars, when you're selling gold, you're effectively buying dollars. So there's like an inverse relationship there. So we are way off the 5,600 high, but I mean, down 13% is quite a lot on precious metals, but I do think we'll eventually bounce back. I think it's just still in shock, really, of how we've performed against how the wider market has performed since the US attacked Iran. Weekend oil, crude plus 2.25%. The Nasdaq 100 is down 0.2%. So it dropped quite heavily last week, and it's down like a further 0.2%. Some of the key events this week, actually this was about 2 weeks ago, but I don't think I actually mentioned this. But so the White House is seeking $200 billion of extra military funding from Congress. So I don't think that they're planning to spend this, but I think they're aware that they can't do this too close to the midterms, which are later this year. So they're just trying to do this now and cover like the maximum amount of money like they may or may not need. But yeah, it just shows you the maximum amount they think they may have to get, I suppose. But the key headline for this week, although again Trump has been quite up and down over this, is that there was an initial 48-hour announcement, but now it's till April the 6th that the US has postponed military strikes on power-related energy infrastructure. So they are trying, it looks like, to possibly come towards a deal. Although I think it's clear, and I think you guys would agree as well, that it's looking more and more where the market isn't really believing Trump, or certainly putting less weight on what he's saying anyway. So whilst this is the case, like, other things are still being hit, stuff's still going on. Apparently that the US wants a deal. Apparently some of them don't. The Iranians do, the Iranians don't. So, it's still really up in the air. And like, there is one sort of theory or conspiracy theory that this is just to buy time for more troops and more military build up to kind of be pushed to the Middle East. And certainly a lot of US Marines, thousands of them, are now heading or have actually arrived in the Middle East, Strait of Hormuz area. So you kind of think, is this a sign of what's to come, or is this just threatening Iran with, a look at what we've got, or look at what we can do? So again, as I was saying right at the start, I wouldn't say a end feels particularly near, to be honest. I also haven't really mentioned Israel much over the last few weeks. I thought we'd mention Israel a little bit today. Israel are really pushing ahead with their offensive into southern Lebanon to attack Hezbollah. So there's still I'm trying to think of like a sort of like a quick version to say it, but like, there's various hotspots. There's hotspots in like southern Lebanon, obviously Israel being hit, Iran, the Strait of Hormuz, the Gulf of Oman over here, but also the Houthis, unfortunately, have also joined the war, and they've now started to re-attack Israel again. As a reminder, the Houthis are an Iranian proxy, which is based in the west of Yemen. And the reason why they're particularly key is because they control the west of Yemen, which is very, very near the Bab el-Mandab Strait, which is another choke point. It's not as important as the Strait of Hormuz. It's not as important as probably the Strait of Malacca over here. But it is a very, very important strait because, of course, the Suez Canal runs through here. 15% of the world's trade runs through this passage of water through the Bab el-Mandab Strait and the Suez Canal. And they are now threatening to close that as well, which is like the outer tentacles of Iran with the, I think it's the Axis of Terror, is it called? Hamas, Hezbollah and the Houthis. So there are more actors getting involved. It's kind of like my broad point here. The IDF are hitting more key infrastructure in Iran. Again, even though there is that sort of semi ceasefire, if you like, against infrastructure, it looks like at least some has gotten through. This week we did see the Egypt, Turkey, Saudi Arabia and Pakistan meet to try and come to some sort of resolution. Obviously Iran and the US weren't there, but they were talking between themselves to try and sort things out diplomatically a bit more. And Pakistan and Turkey have offered the US to broker some sort of deal or ceasefire between Iran and the US. So sort of keep an eye on these countries, I think, in particular. But things are getting worse with energy. Shops and restaurants in Egypt told to close early as energy crisis has deepened. Energy prices are soaring. They're running low on energy. In terms of like the Western world, Australia is by far the most susceptible. For some reason, the country which runs on so much diesel has such a poor kind of backup plan for when a situation like this arises. So yeah, there's shortages and there's dashes to the pumps in Australia and I think in New Zealand as well. So just to give you an idea of some of like the international effects of some of this conflict. I know a few ships have got through the Strait of Hormuz. I believe they've sort of gone over here and paid $2 million in Chinese yen to get through, and they've gotten through. So that's a way Iran are trying to bypass the dollar and get around the sanctions. But I mean, before it was well over 100 tankers went through a day. Since the start of this, it's been less than 100 throughout the last 28 days. So it just shows you just how big an effect this is now going to have on energy, oil, LNG, but also fertilizer, helium, loads of gases, loads of other really key minerals, key parts of production. Just another map here. Like, that I love my maps, so I just have various maps ready to show what could, just to give you an idea of sort of what's going on. There has been more and more talk of US landing boots on the ground, that famous phrase, boots on the ground, regime, like talking about like a regime change. Obviously, two phrases the US population generally hates after Iraq, after Afghanistan, after Vietnam as well. So as I mentioned from this tweet, like there is a Marines arriving in the area. There's talk of them possibly, this is like just theories, but there's talk of them possibly taking these islands of Iran. Of course, I mentioned 2 weeks ago of Karg Island as well, where there's 90% of their oil and gas leaves Iran. Someone also mentioned about the idea of US troops landing in friendly territory and just trying to get a hold of the Strait of Hormuz. The thing is that it's just so difficult to manage because the Iranians have so many things they can do, and they can just threaten things, and it will mean that tankers won't want to go through because, people like civilians don't want to die. They're carrying extremely explosive materials. So they have missiles, sea mines, attack drones, small boats, submarines, but they can just threaten to use these and tankers won't want to go through. So even if the US did build up, some serious troops, weaponry, aircraft carriers, ships, boats of some kind, submarines, it doesn't mean that they can end all the threats because Iran is a very mountainous country. There's a lot of weaponry, bases, various anti-aircraft, anti-whatever stuff, various missiles all around this area because they've been preparing to defend the Strait of Hormuz / attack the Strait of Hormuz for 20, 30 years. Like, they've been preparing to leverage up, as I mentioned right at the start, for decades. So it's a difficult situation. So to come towards the end, so I've got the classic CME group, the futures, looking at the percentage rates, the percentage chances for the interest rates for the Fed. I've got it on the December Fed meeting, so the last meeting of the year. So effectively, this is like an end of the year prediction, and we're currently on a 1.3% chance of a cut for the whole rest of the year. So I know I've mentioned a few times already why it's significant, but obviously this is a massive, massive change from where we were. People were pricing in 2 to 3, possibly 4 rate cuts this year. In SoFi's guidance for this year, for example, they were pricing in 2. Various banks were pricing in 3. Some super dubs were pricing in 4. But to have a 0 rate cuts would be a real massive, massive change. And just looking at the probabilities, it ticks over to us actually having a cut in October next year. So it's just such a massive, massive difference. In the UK, we're now predicted rate hikes, as I mentioned last week, a massive change from 1 month ago. This is the Eurozone rate hikes. So they were predicting to keep it flatline, to keep it flat for the last 1 to 3 months. Now rate hikes. The US, possibly a rate hike, and it was rate cuts before. Just one final thought. So I've tried to present the main core facts, but now to give a bit more of my thoughts per se. This is a great thread, and I'm happy to share this in the Discord, which I read earlier. But just in one of the replies, as he says, the market believes Trump is going to TACO, but he doesn't control the military situation anymore. So TACO, Trump always chickens out. And this is now kind of where my head's at. And I have been saying this on the Discord as well. Trump can TACO tomorrow, but what does that actually mean? Like, Trump TACOing doesn't mean that Iran's just going to give up its control of the Strait of Hormuz. As I said, like it's been preparing for this for 20, 30 years. You know, I think Jordan's mentioned it in the Discord as well. I've been saying it. This has now got to a critical point where I think the oil and gas prices have ruined the Fed's soft landing. We are in a precarious macro environment. The interest rates for the central banks have completely changed, and Trump isn't in control of the situation anymore. I think it's become very, very clear that the priorities of Israel and the US are different and were different, and the US does need to try from now on keep a tighter control of what Israel does and doesn't do. But it's a precarious situation. Energy prices are going up. It's going to affect all of us. Jay mentioned in the Discord, I think this week, that just on a more human, serious note, obviously, like, we all want this to end. I would much rather it end, everything goes back to normal, and just forget any dip or any buying opportunity. Like, this is bigger than investing. This is much higher inflation. This is people potentially losing their jobs. This is people being unable to afford basic necessities. So hopefully this does end soon. I just wouldn't place too much emphasis anymore on Trump's ended it, because he doesn't have that power anymore. The Iranians aren't just going to do anything and everything he says. Like, it's going to take some time to unwind. And one final point. If it does unwind, so if it does end, say, tomorrow, it's going to take many, many months to unwind, because, a lot of things have happened now. Energy infrastructure has been hit. So I'm not trying to be too bearish. I'm not trying to be too bleak. With my purely investing hat on, there will be dips to buy. The indexes are going to go further down. But from a human point of view, from a human point of view, I think we all, I can echo kind of like the sentiment from all four of us. We obviously all want this to end now.
And John, did you have something to touch on that as well?
Yeah, so we had a good question in the chat from Paul around how much the war has affected the stock markets. So if you can put my screen up here, there was this brilliant graph that was shared in the Discord this week, which is highly topical, obviously. And Paul's specifically referenced the Afghanistan war, which is the purple line here. So we can see it took some time for the markets to go red during the Afghanistan war. And then once it dropped red, it took just over a year to recover back to positive. But then if you look at some of the other wars, the Russia invading Ukraine, we all know how that went. The stock market was generally red for a little bit before it recovered. But in some other cases, like Israel-Gaza, the Iraq war, ISIS versus US, they stayed fairly positive or actually grew quite a substantial amount within the 2 years after the war started or ended. So yeah, I don't think sometimes there's not really any way of knowing how the markets are going to react and how quick they will recover. I think ones like this, obviously, I wasn't around to know the context around the Afghanistan war, but this is having a massive, bigger impact on the world than some of the others mentioned, as it's directly impacting some of the biggest influences on inflation and the cost of actually just being able to do business and run things for companies and businesses. So it's quite hard to say, but I think Will might have something good to add.
Yeah, so just on this graph, in general, I do like these because it's like the classic thing. Like I say, like the market goes up, it's basically like a blip on the market if you really zoom out. But to be super specific on the graph, none of these involved a major blockage of the Strait of Hormuz, and that is the energy choke point of the entire world. So none of them had anywhere close to the energy disruption, even though some did. And just to give some context on the purple Afghanistan war, that was right at the time of the dot-com bubble. So actually, that significant low you can see kind of 1 year in, that was just following the natural progression of the dot-com era coming right the way down, minus 80% on the Nasdaq 100. And actually, it just then rebounded with the general stock market following that huge crash. So yes, I know it's good to look at these, and I do agree in 5 years we're definitely going to be up, and probably 2, and probably 1, because that's what the stock market does. But it is important to note, none of these wars had such a major blockage on the Strait of Hormuz.
Yeah, and obviously I didn't know the context of this, so thank you for adding that. I should have really picked that one up, but that's going to sort of segue nicely into my topic around inflation and interest rates. And I've got a nice little graph here to show. US is the blue line, orange is the UK, and then purple is Euro. So this is interest/inflation rates. And if we get to 2001, 2002, we can see this massive incline over the last few years of interest rates, and haven't really started to come back down. They were starting to recover a little bit recently, and then all of this has kicked off. So what does this mean for businesses? Firstly, it has a major impact on the input costs. So inflation increases the costs of the materials that businesses use to build their products, to manufacture their products, and to just overall run the business, like energy costs. And then this will create increased pressures on margins. And then another thing it affects, which has an overall impact, is consumer spending. Higher rates means higher credit. So people don't borrow money. People are spending less. People are keeping the money in the bank. If you don't know what higher credit means, I think the easiest way for people to understand is nearly everyone has a mortgage if they're lucky enough to have a mortgage, if you want to say lucky. So if your interest rates are higher, then your mortgage payment is going to be higher. So the cost of borrowing is higher. And this is the same for businesses, which means the cost if they want to do expansion, if they want to do any renovations, or if they have an emergency and need to borrow some money, the cost of that is going to be immediately higher for the business. And this usually causes a slowdown in spending overall in the economy. Now, with the big CapEx expenditure going on right now, and a lot of the companies are using debt to finance some of this expansion. I think Oracle is probably the biggest one that we can reference here. Companies with high debt tend to rely on rolling over their debt by issuing new bonds to pay for the old ones. But the issue with that is, especially when interest rates rise sharply like here. So if we look down at the bottom, this is probably the perfect time to, get a bank loan, put some money into an expansion. And then by the time your debt is matured, it almost doubled. So say if a company is borrowing 10 billion at 3%, it matures and the interest rate is now at 6%. The interest rate has doubled overnight, which is just another added cost onto businesses. Obviously, you can't really forecast interest rates that far ahead. As you can see, some of these are up and down all over. But yeah, it can be quite bad for businesses. So Oracle, in total, they've took out 19 billion to fund the Cerner acquisition in 2022. So, which would have literally been at the bottom of this little blip here. And then this means that operating income, by the time this debt is matured, has been diverted to pay interest, which means the bottom line is being squeezed and they are making less money out of that acquisition. So when rates stay high, the cost of that debt remains a drag on the net income for a business, which means lower return for shareholders. Shareholders are unhappy. It could reduce the stock price, downgrades in analysis and stuff. But to try and sum it all together, inflation means that CapEx is more expensive, which then means that the return on invested capital is lower, which equals lower profit, which means it's less attractive for investors, or investors become unhappy and possibly start to sell the stocks, or demand changes immediately. So the other thing we need to discuss is why rate hikes and flat lines are negative for stocks. Rate hikes are a deliberate way by the government to try and slow down the economy. If you have if this kept going up at this line, I think it'd be in a massive issue economy-wise. So an increased default risk, which could be a final nudge for bankruptcy for some companies on the blinker. So if Oracle have their debt and this kept going up, and it really put some cost pressures on them massively, this could just push them to fall over and completely collapse. There's been some big cases recently. So the one that I was looking at was Bed Bath & Beyond. They actually took out a massive loan to try and fund their products and their supply chain over the Christmas period. And the sales dropped 20% over that period. They didn't recoup the money. They weren't able to pay for that debt. And eventually they went into administration. So something as simple as that could tip a business over. And then a long-term flat line can be quite dangerous. This means higher for longer. So let's say this blue line here, that's quite high for quite long. That's in interest rates around 6%, which we haven't seen since that period, actually. Maybe it's a little bit close there. But this causes a bit of a drag on the company's profits. And it means that stagnation, it means that the companies cannot plan for cheaper expansion. So really, they've got to be more certain on what they're doing. They can't have any contingency. Everything is going to be a lot more expensive. So they need to be absolutely certain. And if it falls over, it is a higher cost that is going to have a bigger drag. Smaller mid caps burn cash faster. And this could be a bad thing if they can't get affordable bridge loans, as they're called, which is just basically a bank loan that they get as and when they need it. Say for an acquisition, say Ondas is acquiring a brand new company and they don't have the cash there, they might get a bridge loan, and then they might what's it called? Sorry, they might get some bonds soon to pay off that bridge loan. But if interest rates are staying high, that might not be an easy option for those sort of companies. And then when rates remain high, institutional investors like to move out of risky stocks and move their money more into safe positions. I'm saying that because there's always going to be risk involved with every investment that you do. And that obviously has a massive knock-on impact on the stock market. Then the last thing I want to cover on and how this really does have a massive impact on businesses is the discount rate, or the discount cash flow. Higher for longer rates means that the investments will generate less forward earnings. So this lowers the current value of the company's future earnings, because the discounted cash flow is going to be lower if interest rates remain higher, which means that investment is not as attractive if the interest rates are lower. I don't know if you want to add into that, Will, or if anyone else wants to add into that. But that's how inflation and interest rates can have a big impact on businesses.
Yeah, so just to give a bit of context, because I think almost going back that far could be a little misleading. So you have to remember, so say rates went from 3% to 4%. And I don't mean like necessarily like the Fed rate, but just like say like a loan, say went from 3% to 4%. That isn't plus 1%. That is plus 33%, because that's how much like it actually has increased. Which So, which is why the percentage change is actually really important, as well as like the raw number. Because a lot of like boomers also talk about, back in the 70s, my mortgage rate was 18%, and you guys are like complaining about 5% now. But actually, like, there's way more context to that. And because inflation was a lot higher, and because debt of the government and personal debt was a lot lower, and because of prices of certain things were different, that debt was still fairly manageable. But if the Fed interest rates, or say like the Bank of England interest rates, went over 6%, I'm not saying like I've got a perfect calculator, but a 6% today would probably feel like a 20% from like the night, I don't know, like a 1980. So things have changed, and we are very susceptible to small interest rate changes, which obviously we always were. But I guess that's why I'm saying, wow, it's so different from going to 2 rate cuts to none. But I'm not even talking about getting to sort of 6, 8, because I doubt that would happen. But I'm just saying, like, it is important to give context that if you do look that far back, like, there are more factors than just sort of comparing like a like for like number effectively. Like, there is a bit more to it as well. But yeah, I thought, yeah, but I just guess my first point is the actual difference from number to number is also important, as well as like the raw number as well. Go on, John.
Yeah, 100%. And then another thing I want to add into this, and the absolute pressures that it can cause, like Will says, the 3 to 4% is a 33% increase, and that does have a massive impact. So if we look at the bank rate here, as the bank rate comes down, and obviously this is important out of context, the liquidation has come down. But if we look at this little bit here, and these are only small increases, you immediately see that impact of companies going into liquidation. So for quite a lot of companies, if they are quite thin, often Token, a zombie company, I believe, where when the interest is low, they do quite well, but the second it goes up a little bit, it has a massive impact on that net income. They start to fail. So yeah, it is quite a key thing to keep in mind when things start moving. And as Will said, it's not just a big jump from 3% to 8%. It can be as easy as 3% to 4%. Can have a massive impact on a company overall.
Okay, you can see on that image the sort of lagging effects of that as almost as an indicator, and where the bank rate crosses over sort of like the threshold liquidation rate, how it's traditionally quite a bearish thing for companies and for corporations. Yeah, it's just interesting how you can see like a real case example of why some things lag behind, and I think you can naturally give the explanation for it as why mounting rates can cause mounting debts, and then a little bit down the line, even if rates have come back down, the added debt and added cost of debt has already done its damage, and then it has a later effect. And I think we'll see something similar with Middle East stuff and inflationary numbers, and how that will affect things beyond when there's been a resolution in the Middle East.
No, that's fair enough. I think you've all took some good takes on that and offered some great insight on it, John. So thank you, and you will. On the back, go on. Sorry.
Well, I was just going to ask everyone, Jay. Obviously, in my main segment, I was a little bit bearish, a little bit negative. I don't know whether anyone had any balance, any positive light they could add, so we don't end on a too negative note on that general segment. Jordan, have you got anything nice to say?
I mean, I kind of hope some of that will come through it in the next segment. But
yeah,
I think as with ever market downturns, always feel like a temporary experience or temporary thing to endure. And as long as you have the patience and are able to sort of weather it and get out the other side, then there is some greener grass on the other side. But of course, there are some dependencies there, and if you're in bad stocks or bad investments, it's not always going to be just wait out and things will turn around. It's not a guarantee. It does depend on being diversified, being in good stock picks, being in funds, for instance. But I think for them more often than not, it's just it's a case of weathering out the storm.
Yeah, and I think just one thing I do say probably every other week, but in general, when I'm talking about the market, like I am talking about like the key indexes, like the MSCI and More Country World, the S&P 500, I have strong confidence that they will rebound. I have no idea what any individual stock will do because that is completely different. But I do know that multiples will compress of individual stocks during downturns. Meta got to 4 forward PE in 2022. So with those high beta stocks, like the multiples will compress. That's what happens. And that's why, being in an index fund can be beneficial, and hopefully that's a nice little segue for you, Jordan, as well.
Yeah, we will touch on that side as well, won't we, on the question of the week? So, George, to go into your section now, how to respond in 2026 to this stock market uncertainty. Have you got? Do you want to share your screen? So there we go.
Yeah, it should be there if you want to let me know if not.
Yeah, I've got it there, mate. It's on the screen.
Yeah. I was just looking back at it. I found it ironic when you said there's not anything positive to say, and I think all three of you said Jordan. I was just looking up at the predictions table with me of 3 green predictions and 8 red predictions, and the most predictions out of everyone.
Well, I just sort of, I don't know, I thought that you might have like a little dash of positivity out of all of us.
The most bearish person so far.
Yeah.
Cool. So yeah, I just wanted to kind of spend hopefully like 15, maybe max 20 minutes, just running through kind of how to respond, how to manage your own investing, just my opinions of it. Of course, not telling you what to do, not giving you direct instructions, but some of my opinions around it. I think like what the options are and sort of how to just sort of thinking around them and some reasoning behind them. So where we are now in sort of current negative downturn. So we've got an all-world index on the left. So not just S&P, of course, all around the world. It's a very global impact that the Middle East especially is having. Down 5%, and you would have seen if you're in the server on the right, the Max 7s as well, which have traditionally been in between individual stocks, although they are themselves in between sort of growth stocks and funds, as somewhere in the middle where they've got like a balanced risk to reward ratio. But those have actually had quite a big downturn across the board since the start of the year as well, and that's from their 52-week high. Then, as you would have seen from Will sharing, the volatility index is also been creeping up year to date, and just recently we've got to a new peak. So that's looking at the next 30 days. The forecast is for more volatility than we've seen yet, and that traditionally sort of coincides with the opposite direction for stock prices. When we see the VIX going up, usually for the most part across the board, stocks go down. And then the fear and greed index is in extreme fear at the moment. So that's CNN's sort of consumer investor sentiment survey that kind of measures how people feel about the near future. And as you can see, it's not overly positive at all. And then finally, just S&P 500 year to date. If you were living under a rock and you came back, you looked at this, I think you'd have a pretty good indication straight away of what's happened by the sea of red and then a big green square in the middle around energy and minerals. Then it should tell anyone straight away what's sort of been happening. It's to do with conflict, it's to do with war. When you see oil and energy going up and everything else going down, so if you're looking at a portfolio right now and it's down, I'm sure there's plenty of other people that are also down that would tell you themselves, and it doesn't feel like it's anyone's fault or their own. If you look at across this board here, you're probably invested in a lot of these names, either individually or through funds, and look how hard it would be to be green all in all. So kind of looking at what we can actually do as investors, like what are our options. Now, you could potentially try and guess the future and try and predict the market and decide this is going to happen at this point. So I'm going to do this, this, and this. And I think, as ever, it's a complete no-go to try and guess the market or predict the market. Hedge bets, of course, that's what investing is. But thinking you can guess, absolutely not. And I think just assume that you have absolutely no possibility of ever getting anything right. The weekly predictions, assume you got those wrong every single week, then what would you do in that case? So I think fundamentally there are 3 things that we can do that take out any emotion, take out any opinion, that are just factual things that we can or can't do. So we can sort of sell out of positions. Maybe part of that is panic and fear, or we can sort of sell out to protect ourselves. We can hold on to what we've already got, have our existing portfolios, our existing assets and holdings, and just keep them as they are. As I said, just sort of wait it out and let the sort of the storm pass on. Or of course, as you've seen people say a lot of the time, we can buy up the dips. We can just buy more of the assets, use cash that we may have, buy things when they're down at cheaper valuations. I think as an overall, the first one for me, as I say, these are my opinions, not so much. I think I can see some justification for it for sure. If you're positioned in a way where some of your investments you may need in the near future, you're not too sure how long it may last for, then maybe there's some justification there to sell out. But I think for the most part, there shouldn't be the sort of temptation to, because it's probably steering away from what is your existing strategy and long-term strategy anyway. And you shouldn't let something that comes in that we know is going to be temporary affect and sort of push you off course from that wider strategy. So I think the other two, for me personally, are the best options to look at and the best ones to have. And as I say, I think these three as a whole are the only sort of real fundamental options that we can do that exclude the sort of opinion side of it. So just looking at buying up more assets, we've got some animations. Our budget's gone through the roof this week. So yeah, buying up more assets. So I think firstly, if you do think to buy up some assets, there's some sort of things you need to check within yourself. So firstly, for this one, for 2026, does this is there a crisis? And does this crisis or the fear or panic or the correction as a whole across the market, does it feel like an opportunity to you? Does it make you feel like, okay, these things are cheaper, they feel really appealing? Does it feel like something that you want to jump at? And are your investing goals long term? Do you have the capacity to go through whatever the crisis, the fear, panic, or the corrections, however long they last, and go beyond that and look beyond that? And lastly, has it changed your conviction? And I think if your answers are to all of those, does it feel like an opportunity? Yes. Are investing goals long term? Yes. And is your conviction unchanged? No. Then you can look to buy up assets. But I think if any of those questions feel like a bit of a worry, then maybe you sort of reconsider and go back over those answers and why those answers are the case for you before starting to hedge more of your capital and buy more assets. So hopefully a man that needs no introduction, a famous wise man once said, to look at market fluctuations as your friend rather than your enemy. So I think we said it before, where volatility often breeds opportunity. And hopefully a lot of people do feel that way, that as much as it may not feel nice in the immediate term to see your portfolio go down or your numbers go down, that at the same time seeing other stocks that the fundamentals haven't changed and it's only the macros pulling them down. And maybe stocks that you're already buying up or you were looking to buy up and all of a sudden now they're cheaper than you're already happy to buy them at, then feel it as an opportunity rather than a downside. Feel it as something beneficial to you. So looking just more broadly, and this is the S&P plotted on a graph across nearly 100 years, and this is a graph where the data is inflation adjusted. This is from macro trends, so they take the headline CPI data and represent it to the month. So basically what this does is it takes out the inflationary side of the S&P index and sort of plots what the real value growth has been. So rather than being like a slightly unhelpful exponential curve up where you can't really see what's happening in the early years, this kind of puts it down to a more relative sort of graph to each decade and each year that's gone past. And I think no matter who you are, if you're someone that's never looked at a chart before, you can still see the general trend, the general direction the market goes over a long period of time, and sort of the macro trend that we are seeing. And that's something to put into, when you're thinking about these things and in these corrections and these negative downturns of what that macro is. You've got that big long-term macro going up, and part of the reasons for that are just as is almost naturally and will fundamentally happen. For the S&P 500 and for the world as well, because the S&P 500 is very global where its revenues come from, and this is focusing on the S&P 500. As the US has population growth and the whole world has population growth, and both the US and the world sees economic growth, then there's already like a backbone and a basis of numbers that are growing to then grow the funds and grow the index as well. Naturally the S&P 500 is a rotating list of companies. It's not 500 companies that are just stuck there. It's almost a natural selection process where by definition, and by the way that it works, the 500 best performing companies, give or take a few, with some asterisks, as we've seen in previous weeks, there are some in there that bit questionable why they're in there down at the bottom, and others that aren't in there that we all think should be.
The trade desk.
Exactly, yeah. Sort out trade desk for SoFi. But yeah, I think, it naturally is part of its design. It's a natural selection of mostly the 500 best performing companies. So you're going to S&P 500, you're naturally having that exposure to a rotating list of companies that brings in high performing companies, eventually kicks out low performing companies after a while, and kind of naturally has a little bit of a spring clean almost for you if you're invested in S&P 500. And then, as well, over time, technological progress and productivity, companies can now, from one employee, generate much more revenue than they could 50 years ago. And I'm sure that trend is going to continue. As I say, that naturally feeds into the numbers they're able to raise, the revenues they're able to generate, and therefore the value of the holdings, the value of the S&P 500. So I think those three things, in addition to the macro trend, or part of the reason for that macro trend, kind of give a bit of confirmation and reassurance of long-term, while the continued performance of the S&P 500 and also globally can continue to be, a rising value rather than a decline. And it's just those short-term downturns in a bigger picture of a sort of an uptrend of a zigzag, if you like. So with a big pinch of salt, I just want to show two sort of possible scenarios. And as I mentioned just a few minutes ago, I think this is quite dependent on stock picks anyway. This isn't going to apply to every stock pick, and this definitely isn't a blanket approach where anytime you're down on an asset and anytime you're in a negative sort of market correction or market downturn, that this works all the time, and any stock that ever goes down is always going to bounce back. Because that's not the case. I think this depends more so on funds, more so on indexes, and more so on there being sort of really strong picks. So if we look at scenario A, let's say this is scenario A. This is a specific stock that you're in. You've had this bull run, and then all of a sudden you have this quick downturn and market downturn. So this is obviously we're looking at buying more assets. So let's say then bought at the bottom of the dip there, and then eventually it went back up to new all-time highs. So you've acquired more, you've gone through that dip, and you've ended up with more shares at a higher price, more value gained. Then let's say scenario B, same thing again. You've held something on for a while, it's had a run up, or you just got into it and it's had a recent downturn, and then you buy a bit more because you're buying up assets, and that's your response to the market downturn. And then it goes down more. So do you hold off there, or do you buy more again? And maybe you do buy more again, and maybe then it goes up later on. It might be a prolonged dip, it might be sort of half of a recovery and then go back down again. And maybe you buy in both options, maybe you hold in one option, but just to sort of bring into perspective what the macro trend could look like. And these are real-time examples. The one on the left is from early 2025. So that dip there is from April 2025. And the one on the right is from sort of 2022 onwards, when we had a year about worries of inflations, etc.
So I know that I've looked at the charts so much when I could instantly tell exactly what years both those are from. And I was hoping you might ask, but no, you told us, fair enough.
So I think it's good to know that these are actual, real and recent examples of, where there's suddenly been a sharp downturn or there's been a prolonged downturn. And just think like maybe in those situations, how you might have acted, how you might have responded. And as I say, just bringing in sort of like the idea of that macro trend as well. And then going back to the other one, so not selling out positions, holding on to that, I should say, sorry. So just holding on to a net pass. So that in this instance, in this sort of response, where we're not buying any extra things, we're just going through the downturns, going through the corrections, and kind of just waiting for them to pass. And this is from Stifle Investment Strategy, and I want to spend a bit of time on this graph actually, because I think it's a really valuable one. Forgive me if we've shared it before, I couldn't remember if we had or not. But I think it says a lot about sort of long-term, being in the market long-term, both the history of it and sort of what you may roughly sort of expect for the future, and how those downturns really go. So as it says here, the cycle of markets is inevitable. Markets are going to go up and they're going to go down just the same. But for the most part, markets are more bullish than they are bearish when we're looking at the S&P. So historically, bull markets last much longer than bear markets do. The average bull market lasts for just under 5 years, and the average bear market is about 1.5 years. And in that time, the bull markets average out 177%, and bear markets average down at 35%. So there's quite a strong bias there historically for both how long bull markets last and also how how large they are gaining versus how short and comparatively the bear markets are, and how much less they sort of reverse and correct. And also you can see recently as well, like in the past, from 2008 onwards, how much has been bullish. How the long-term investing would have paid off for you during that time. But I just think more generally, if you look across that, you can very clearly see how much stronger those blue bull markets look on the graph compared to the red bear markets. And hopefully for those who haven't seen something like that before, gives them a little bit more confidence about how quite ultimately durable the American market especially has been. And where we currently are is we're currently sort of roughly 3.5 years into a bull market that's yielded about 92%. So against the averages, we are slightly below. That doesn't mean the bull run is definitely going to continue from here. I'm not going to just flood you with bullish sentiment and send you on your way full of massive overconfidence. But we're definitely not at a point where it feels like we're beyond where we should be. Albeit the last sort of 20 years, kind of 20 years, have been much more bullish than bearish for most 20-year periods. But just to show roughly where we are and how that compares historically. And then the other thing sort of on kind of just weathering the storm. So this shows most of the major conflicts or international conflicts and how the American market has performed during those times. And as you can see, for the most part, and we'll touch on this, I think for probably the past couple of weeks or past 3 weeks, how often the market responds quite well within a 12-month period. To give you a little bit of bearish sort of thought and sentiment, on the left box, second from bottom, the Yom Kippur War, I think a little bit to what Will said earlier about there hasn't been a war before where the the Strait of Hormuz has been blockaded. The Yom Kippur War, I'd say in some ways, is possibly the most comparable to this one, in the sense of back then, the big macros that were pulling the market down were high inflation and oil prices. So oil prices went up loads during that time. They doubled the same as they have now. And there was actually an oil blockade. So although the Strait of Hormuz wasn't closed back then, there was an oil blockade on the US. And so some similarities there in terms of the threat of supply of oil. Whereas now it's not so much with the US, it's more global supply of oil and how it affects global markets. Back then it's more the US supply of oil. Obviously that was quite a long time ago, over 50 years ago. I think things are different now. The US doesn't depend, as Will said, on oil from others like it did back then. But there are some similarities there. So just a little bit of bearish sentiment and bearish sort of thought for you to think about. That's probably the most stark on this graph, possibly the one with the most similarities, but also lots of differences as well. But I think as an overall, it's good to show you, how some of those total drawdowns look initially versus a year later, how much the market often bounces back, and we've touched on that a few times. And then Derpy shared this in the server this week, and I thought it was interesting just to share. So again, where we are roughly with the sort of the political side, and Will's also touched on this in many ways over the past few weeks, and how the sort of presidential cycles often line up in this way, and the very strong track record of how it bounces, a year down the line or even 2 years down the line. So there's lots of different, reasons why you can feel, I think, why people should feel confident to be able to just ride the storm, get through to the other side, and feel positive about what the other side would look like. Because as much as we always say history doesn't dictate or guarantee future returns, it can give some guidelines and give you some loose expectations of what you should be looking out for and how confident you may or may not feel going forward. And then just lastly, to leave you with something. So Charlie Munger, who was the ex-vice chairman of Berkshire Hathaway, and Warren Buffett said he was the architect of the modern business philosophy. And obviously Berkshire Hathaway is probably the most successful example of compound interest and investing from, I was going to say nothing. I think back then their capital was quite a lot, even for that time, to a lot more. Probably the biggest sort of success story of investing. So very important man of that. And there's a quote from him saying that the big money isn't always in the buying and selling, but it is in the waiting. And I think that's a good thing to leave on. And I said this a few times. I don't think there's always a need for action. Sometimes the best thing you can do is to do nothing. So I don't always feel like when something happens in the market that you have to be doing something. You don't have to sell, you don't have to buy, you don't have to be doing this and that. Sometimes you can just wait. We know time is the best compounder. We know time is the biggest factor really to your investing portfolio and what it might look like in however many years' time. Is more about how many years there's been rather than how much you put in. So yeah, just something to leave you with is sometimes you don't always have to do something to respond to something.
Are you muted, Jay?
Yeah, I know. I keep doing that. Have you lads got anything on the back end to touch on that?
What should I say? Like that was like my perfect segment. It was just some great, positive, long-term investing advice. Just everything's going to be okay. Like the short term might be crap, as I was saying as well, but that's okay because we're long-term investors. Just keep buying every month or every 2 weeks or whatever you buy, and things are going to be okay long term.
Yeah, no, totally agreed. So I was just about to get a question a week. John, is there anything you want to touch on that, or?
No, I couldn't agree anymore with what was just said there. Time is to our benefit, so make sure we use it properly. There's no point worrying now if you're investing in Horizons the next 30 years, because there could be a few more instances we have to go through like this. So really, time is your friend. Use that time and don't panic.
No,
we can't control anything, can we? Like all we can control is how much money we can put in the market, effectively, right? That, through working or through savings or whatever it is. We can't control what Trump does or what Iran does or Israel does. So sometimes also I think it's good to zoom in and just focus on ourselves and block out the noise, because Jay, I like to say, like, we're not noise investors. We're just, like, even though we talk about the news every week on a Sunday night, we're not trading the noise. Like, we're not trading the news, are we? We're just, we're just talking about it.
And I think on the back of that, about the zooming in and doing nothing, sometimes it's mostly important to zoom out. So the reason I say that is I've just seen someone comment in the section saying about Ondas needs to sort something out because it's 30% down. I understand that's obviously frustrating for some people, but sometimes you have to zoom out. And some of these stocks over the last 12 months, whether it's Ondas or many other stocks, have had significant gains. So a 30% drop or a 20% down, yes, it's horrible if you've recently got in. But to the average person as well, obviously some of these moves are still substantial, but not massive over what they've seen it grow in the last year. So this week's question of the week: do you prefer having more or less allocation to individual stocks or index funds in your portfolios? We're going to go back to front. So George, you're going to go first.
So for me, I'm about, I think across my entire portfolio, roughly 45%-ish in funds. It's previously been half. Obviously, things shift as individual stocks grow and funds don't grow as quickly, for instance, and rebalancing will come through. I like to be about equal, given taking away cash sums, about equal between funds and stocks, individual stocks. As I said before, funds are part of sort of the anchor of my portfolio and part of the wider strategy, and give me a bit of stability and resilience to the market. And it's almost like a separate strategy where I have my fund allocation. I have a set amount that I put in, a set amount that I started with, an assumed return per year across an X number of years to get to an X number at the end of when I'm 50, 55-ish, as a separate strategy to the other bit of investing. So I like to keep them quite separate. Yeah, I'm personally about equal weight.
For me, in my stocks and shares ISA, I'm currently aiming to have 30% towards index funds and the rest in individual stocks. In times like this, I'm mainly focusing on the interest in the index funds, and then holding a bit of cash back and just putting into the ones that are less volatile. If you were to look at my overall portfolio, though, I don't know if you included your pensions into this, George, but I pay my pensions quite safe, and that's only in index funds. So if you were to look at my overall investment portfolio, I've probably got around 70 to 75% in index funds. I hadn't really considered that until you started talking, and I started thinking about all of my investments, because sometimes it's easy to forget pensions when you don't really see it. It comes out your pay.
Don't forget pensions.
Yeah, I know. That's what I've realised. But yeah, individual stocks is a heavier weight in my stocks and shares, I said, but pensions wise, it's only index funds. So it probably will end up being around a 50-50 split by the time I want to retire.
So with myself, I'm getting towards my goal of around 90-10, so 90% in funds and then 10%. So I see it more as like a 90% ETF index funds and sort of 10% more of like a fun portfolio. I quite like that idea. So I still, have my individual stocks in there, but it's not catastrophic if they don't perform well. But I love the diversification of index funds. I love the history, like the financial history, as Jordan outlined over the last 20 minutes. Effectively, those charts summarized in a really basic way is the market goes up over time. And we've got such a good record now of well over 100 years of it doing that, of it consistently doing that over decades and decades, generating that the best returns over cash, over bonds. And why I don't want more individual stocks? Personally, I'm very aware of the statistics and the data showing how difficult it is to be a stock picker. It's certainly not impossible. A lot of us have made a lot of money on stocks, and plenty of people in the world have made a lot of money trading or just holding stocks long term. So that's why I have my 10%. But overall, I do think it is difficult to beat the market. And over various points I have mentioned, if the S&P 500 does go down 20% this year, some of our favorite stocks are getting cut by 50, 60, 70%. So it can be brutal in difficult times holding those individual stocks. I'm always open to reassess. I'm still relatively new. If I want to change it to 80-20 in the future, I will. But right now, I really am happy with my 90-10 split. And yeah, I think it's good on time and mental health. As much as I love to track the markets and everything, you don't have to, be involved as much if you know that 90% is just sat there, safe, compounding, doing its thing.
Yeah, and on my side, I'm pretty much the opposite. I'm 95% individual stocks and 5% in index funds. But as the years go on, you will notice in my portfolio that percentage switches more and more. I won't break into it too much now, but we had a in-depth conversation about whether lump summing or dollar cost averaging into funds was good the other day, which is what we're doing. But we had a really good conversation inside the Discord. But yeah, as the years go on, the percentage will start to switch over slowly, and eventually it will become more index funds. It is less emotional to invest in just index funds, but me personally, with being the age I am, I'm happy to take more risk. So yeah, I like the allocation into individual stocks at the moment. But yeah, as time goes on, that percentage will definitely massively switch over.
And then some clown in the Discord was saying that actually DCAing is lump sum and we're trying to break everyone's brains, right? So
it's always fun. We have the greatest discussions, but that's what's important. And it turns out that lump summing is definitely better. But it depends on what your lump sum is. But that's a conversation for another day. So obviously into the next, we're going to start looking at the week ahead, earnings and macro. There's not that much that's going on in regards to earnings in the coming weeks, but we will have a look.
Just while putting that up, Jay. So when you asked me what am I thinking about earnings next week, obviously we have Nike, but
That's
earnings effectively coming down, like winding down to a close. We'll have like a short break, but then we restart again. Then we effectively go again. And I'm just throwing this out there. If Trump wants to, I know my opinion on this. I'm putting the idea out there of, instead of scrapping 3-month earnings and going to 6 months, what about every 4 months? It's still divisible by 12. It still works in a year. Forget quarters. We're now having thirds, because quarters low-key does feel too often, but 6 months would feel way too unoften. So I'm saying meet in the middle, kind of 4 months. But yeah, I mean, it's a quiet earnings week, Jay. But literally in 2-3 weeks, they'll be jam packed again with all the banks. So,
And this is what people sometimes get the misconception about when they own like a couple of stocks. They just think earnings comes around every couple of months and disappears, but actually, near enough earnings never stops.
yeah,
And these are only normally the most popular stocks or well known. There's hundreds of thousands of other stocks that get show earnings every other day that people don't even talk about. So
yeah,
it's definitely really, we don't really need to bounce around everyone. I think everyone can agree that really it's just Nike that's going to be the watch. And Nike's been very interesting, to be honest. I had some price alerts set up on it from back when the Chinese tariffs and the term and stuff like that. Where do they get their main supplies from? It's China and it's on the tip of my tongue.
Vietnam, yeah.
Vietnam, yeah, that's it. And to be fair, their share price recently has been hitting my price targets, which means price alerts, which means it's dropped significantly. I believe I haven't even looked. I just kept seeing it pop up on my phone. But other than that, next week we've got the US. By the way, excuse my messages all down the side. I look dead on reply. I look dead antisocial. US market futures open, so it's around War Day 30, which is obviously tonight, 11 p.m. The Fed Chair Powell speaks tomorrow. We've got March consumer confidence data on Tuesday. February JOLTS job opening data on Tuesday. March ADP non-farm on Wednesday. March retail on Wednesday, and then March jobs report on Friday. Jord, have you got anything that you want to add on to that?
Nothing to add on. My focus for me will be the job side. We've seen a lot of the inflation numbers worsening, and it's also just then monitor how the jobs market does or doesn't worsen. Because they're the two most important things. They're kind of on the opposite sides of each other to interest rates, which is like the big talking point. So yeah, seeing how those shift and how they come out.
You got anything you want to add on to that, Will?
Well, yeah, I think it's just like a week for jobs, really. Like just looking at jobs data, but also it just reminded me we have now resynced up back with US time, so we're back to the 5-hour difference rather than 4. So 11 p.m. tonight futures. The market opens Monday to Friday 2:30, shuts at 9 p.m. Yeah, so we're back to our usual 5-hour difference.
And how have you guys felt about that? Because if I'm being honest, I've actually preferred it being an hour earlier. I don't know if that's just the impatient side of things where things are coming out earlier, but how have you lads felt about it? Do you prefer the time it normally is? Do you like it when it's an hour earlier than normal? What do you think?
I kind of prefer it earlier, partly because of the platform I'm on. You have to get your buys in by 2 p.m. and then they buy. But if the market opens at 2:30, you're gonna have to put your buys in before the market, before the US market's even opened. Whereas on this one, you sort of got like 29 minutes to sort of reassess. But honestly, timing wise for me, I think because I am a bit of like a night owl and like always like quite a groggy in the mornings, I probably would prefer it like the 5-hour difference. So I'm like switched on really for both of them fully.
No, that makes total sense. And then going into the predictions, and then we're going to answer some questions at the end. So we have got a few questions. So if anyone else has got any questions, ask them away, and we'll pull them up soon. So we're going back to predictions now, and obviously we're going to go bottom to top. So we're going top to bottom, aren't we? Will, how do you want to do it? You're top of the table. How do you want to do it?
Well, just to make sure Jordan doesn't complain too much, I suppose I better go first.
Go on, then you go first.
But doesn't mean I won't buy myself a little minute to think, if that's okay. Because as I have been saying every week, this many red weeks in a row is a lot. So the last time we saw this was April 2022. I'm going to count again. 3, 4, 5, 7. So it was 7 weeks, almost exactly 4 years ago. Based on my general sentiment, I'm going to have to go for that big, brown, ugly red bear again, I think. Unfortunately.
And yourself, John?
Yeah, I'm going to go for the red bear as well. Then if we're both wrong, at least I'm still in touch and distance of first place.
He's playing tactical with
it. What do you think, George?
I can't believe I'm not second last pick anymore. This is momentous. I've overtaken you and I'll go third. was just looking at the chart a little bit TA wise. So on the weekly, it's gone through its 100 SMA, 50 SMA. And the last time it did that was early last year. And when it did go through quite cleanly, then it went down further. And although we've had 2 bigger candles in recent weeks, I still sort of feel that, again, the first 3 weeks that were red were fairly small. So it's really only the last 2 weeks I'm kind of looking at in terms of how much the market's moved. And I don't really see much support there. So I'm going to just bring in some TA sign and use TA to go off of my prediction this week and just say red.
Okay, and then that's me after. So I think that Trump knows that our ICE is reset in the next couple of weeks. So I think he's trying to buy us some more time before that happens. So I reckon he's going to give us another red week. I think if we need to be starting nearing towards that deal, etc. or something, but it's been a quiet weekend, which doesn't fill me with hope. So I'm going to go red this week. The stream as well, 86 votes. It's a 34% in favor of green and 66% in favor of red. So I believe for the first time since we've been streaming now, every single person has gone red, which is normally a little bit of obviously a little bit across the board. I was thinking be the anomaly and go green, but yeah, I just I don't see. But yeah, so John, I know you've got to bounce now. Really do appreciate your time, mate. I have dropped John's YouTube in the description, so be sure please to go give him a follow. He posts a lot of content as well. He has got a terrible accent, but he's all right.
Thank you, really appreciate that. In my latest video, you'll hear me say Palo Alto, which Jordan thinks is the best thing ever. But yeah, it's been a good stream, and I hope everyone has a good week going ahead. But yeah, thank you and good night.
Yeah,
No,
nice
in a bit, John.
In a bit, mate.
So going into some questions. So we've got 6 here so far. Let me pull this away first. So we'll probably do a couple of these. And so first questions first. What sectors are you all looking at the moment? I'll go first. So at the moment, I'm not necessarily looking at any new positions. I have positions that I'm happy with, but financial sector is being smacked a little bit. So there's some stocks I'm watching there because of rate hikes and stuff like that being noticed. But yeah, that I'd say if there's a sector I'm looking at, financial sector is probably the one that I'm paying more attention to.
I think actually all 3 of our answer is basically what you just said, I think. And I'd just make it a bit quicker as well.
Yeah, it probably makes more sense, doesn't it? Right. How do you fundamentally think the conflict ends? Iran bends to demands or US invades and takes over? Trump tacos? In my agreement, I think that the way it ends is going to be a deal. I don't. Obviously, I think Trump tackling has already happened, really, in an essence of so many degrees. But I think there'll be a deal, and that's the way that really that conflict ends.
Yeah, I think there's gonna be a deal. So I think this sort of has to be. Iran agrees to open the strait and to leave the strait alone. They also agree to stop enriching uranium to 60% and to never build a nuclear weapon. But the US is obviously going to have to give them something back. I think the main thing we can give them is unfreezing a lot of their assets, which is effectively giving them money, unfortunately. But we do have billions and billions of their assets frozen. So it'll be unfreezing their assets. And potentially lifting some sanctions on their oil as well. I think in an ideal world, there would be a deal like Obama signed with Iran, but actually meant something more and didn't just buy the Iranians time to, use that money to give to Hamas, to give to Hezbollah, and to slowly break the deal. So I think it needs an important deal, but one which is actually going to be respected. I do think there's a chance that the only way the Iranians agree to the deal is if Israel officially recognizes that it has nuclear weapons and joins the nuclear proliferation treaty. So the nuclear guys can go and inspect their nuclear weapons and become officially part of that treaty. I do think that Iran are going to force Israel to be involved in some way in that deal, because it feels like, why else would they agree? Because they've just left their major enemy in the Middle East open and fresh. So we are going to have to make decisions to benefit them as well. But I think for now it's going to rumble on, and I can't really predict like the short term, or just like at the end goal, I suppose.
So, Jordan, this next question I'm going to have for you, because obviously I don't want to keep answering them. When is it ever right or good to sell a stock? Situation normally don't need any capital, just feel need right to sell due to gains. So I guess the question is, when's the right time to sell a stock? I know you'd love this question.
Yeah, we've spoken about it before. It's definitely something we need to run through in a future stream, because the focus is always about buying the dip, or when to buy and when to weather the dips as we've gone through, and less focus on when you actually sell. And I think there's as much importance on knowing when to take profits and knowing when to rotate money into other places that might do better for you and that sort of thing. And there's definitely a skill to it, unless we're focused. So for sure, it's an area we can focus on. When is it ever right? It's hard to give an answer. There's so many different considerations, in the same way as when is it right to buy. There's simple answers, like if you're in the money, then it's never really a wrong time. But of course, there's also added bits to it. It's not as simple as just as soon as you get green, sell, because then you might be cutting your potential profits way earlier than you need to be, for instance. So I think it's almost like put a pin in that for now, until we can have that big discussion on future stream, because there's so much to it. It's actually quite hard to condense down into one answer, because it's like a matrix of different things that are all unique to the individual.
You got anything you want to add to that, Will?
Well, yes, but again, it's like a whole big thing. So I think we'll just cover it in a 15-20 minute segment, maybe in 2-3 weeks or something.
No, that makes total sense. And on the back end of this one, so Will, is it bad to have all individual stocks if you're investing for the long term?
Good question. So I wouldn't say bad, although I know that obviously you've only got like a certain character limit. You haven't written it in a perfect question sense. So I don't think it's like a binary good or bad. Although obviously you heard my answer to the question of the week, so you know that my focus is more on funds, on long-term index fund investing. I do think that everyone should have an index fund anchor in their portfolio. I normally recommend to people sort of 50 to 90% of your portfolio being in that basis. It's like an insurance policy almost. If you F up all the rest of your stocks, you've still got that index fund compounding and growing away. So I do think as well that as you learn more and more about investing, you realize just how much time it takes to truly cover an individual stock. Like I say, the initial research is 15 to 25 hours to do it properly. And then every month it's probably 5 to 12 hours every single month, and then probably more during like an earnings month. So that is a hell of a lot of time each year, like if you add it up. So would I say bad? No, but as a long-term investor, I would highly recommend, obviously not financial advice, but I'd highly recommend having at least one global index fund as your core anchor insurance policy. And also, like, we never claim to be experts. Obviously, like you guys watching don't claim to be experts. I think it's always good just to have that index fund ETF to really help build your knowledge as well, while you learn more and more and more. Like all of us still, of course, learn every single day about this stuff. There's so much to learn in this space. So I think it's good to hold those individual. I think it's good to hold those ETFs just to like give yourself time to learn more as well.
Yeah, no, I think that's a great answer. And the last question, we'll do one more before we jump off. And Jordan, I'm going to give this one to you, mate. Is your goal to beat the S&P 500 each year?
Ideally, I'd love to. Yeah, I mean, I've got a good hedge in the S&P 500 anyway, and all world, which is obviously quite US heavy. So to some degree, I'm almost in line with it. But I have had like a good track record of beating it year after year. It's not going to be a 100% record every year, and I'm not expecting that, and I'm being realistic with that. But of course, that feels like the goal, the extra risk and exposure that you're taking to have individual stocks. It feels like you'd only do that if it's got more reward than a fund. Because if it's got more risk and doesn't have more reward, then there's absolutely no point. So yeah, definitely the extra risk is there to have more reward. So yeah, I guess by default I am aiming to beat the S&P.
And do you want to add anything to that, Will?
Well, classic. Jordan and I have got a very similar opinion, but yeah, I was going to hammer home the point that I think by default you kind of have to be, otherwise what's the point? But as I said earlier, in those drawdown years, in 2000, in 2022, you are going to do worse off the S&P 500. So it's about looking at annualized returns long term rather than 1 year, because like your port could be minus 35% this year, but the S&P 500 could be minus 20. So it's good to have average them out and really get those gains during the bull run, and then try and protect yourself to the downside during those negative years. But I mean, isn't that the whole point of individual stocks being that? So yeah, definitely.
No, I think that's been great. And again, lads, I appreciate the time that you've taken for this evening, and we appreciate everybody coming to watch and tune in. So that's been One Big Stock Market Sundays with me, Will, Jordan, and John. And thank you very much for everyone who's tuned in.
Thanks, guys. See you next week.
Cheers, Rob.